Welcome to the deep dive video update. This is a weekly video where I go through and I look at the charts, mostly the daily charts, and I pick out those charts that maybe I didn't use at all, or some that I might have used at some point during the week, but I'm not using them right now. We look at those charts to see if we're getting any kind of insight as to what's happening in the markets. And then there are other charts that I use just in this particular video, mainly for informational purposes, just to give us a little bit bigger picture of what's happening in the overall market and ultimately what's happening in the S&P 500. This is being prepared for Monday, July 14th. Before diving into today's video, if you find it helpful, consider a 30-day free trial to the SPX investing program. This trial lets you explore my unique approach to market analysis. Full-length daily and weekly videos are available on a delayed basis after the market closes. For immediate access, become a member by clicking on the link below. The first one, this is just for this video. It's informational. Just gives us an idea and a bigger picture of what is the VIX doing, the fear gauge. And when it's in a higher range, that's when the market is going down and under pressure. When it's in a lower range, that's when the market is going up. And even though we were coming back up as we were going down in March and April, we never got above that 20 level. And now as we've been coming up out of that, setting new all-time highs with the S&P, we're rolling over with the VIX. So when this is going down, that is more positive. Then we keep an eye on the speed of the VIX. This is on a daily chart. And we look for extreme readings, either positive or negative. We're below the midpoint now for the most part. Even though we had a down day on Friday, the market's been holding up quite well. And so the VIX is kind of settled down under that 20 level. And we're also seeing where the momentum of the VIX is measured by the RSI is also dropping down a little bit. Not getting any kind of an extreme reading, so I haven't been showing this. Now, I used to show this pretty much in every daily video. We want to get an idea, what is the momentum of the VIX? Is it going up or down? But we've pretty much flatlined right now. So I dropped this from the daily video for the time being. If we start to go back up or down, then I'll certainly pick this up. But we're not really getting a lot of additional insight here as we've been below average with volume. We're seeing some really slow days. Then we see a day with some real conviction, either up or down. But the VIX overall has just really been settling down lately. And we look at the VIX in a correlation with that with the S&P 500. Getting very low readings right now. We pay attention to this chart when we go above the dashed line. We're not there now. And then the VIX, and then we do a ratio with the VVIX, which is like an indicator of the VIX of the VIX. And in this context, as this is going down right now, that's more positive. That means that the VIX is going down more than the VVIX on a ratio basis as things have been going up and the VIX has been settling down. Then the SKEW Index, we did get a high reading here at the end of June into July. There was some anticipation that there would be a big move to the upside, and we didn't really go anywhere. We broke higher after that, but there was a lot of pre-speculation using options to think that the market was going to move one way or the other. And now, since that time, we've dropped down out of this red area. We're still getting kind of a high reading, but we really only pay attention to this if we get up into this area, and we're not there now. Then the Ulcer Index, which is another sentiment gauge, we're below the moving average, showing that a lot of fear has been coming out of the market. Then we look at a ratio between the volatility of stocks and the volatility of bonds. And in this context, the red line, that's mainly what I follow, is a 50-period moving average of this ratio, and it has been declining as stocks have been going up. And we look at another ratio between large caps and small caps, and we did come down. Now, small caps did okay until Friday this past week. They pretty much gave back their gains, but we were seeing some strength, not only in the small caps, but also in the mid caps, and that was causing this ratio to go down. When this ratio goes up, that means the large caps are outperforming, and we are coming down here. And the small caps, they still have a lot of damage to repair, but they're generally showing some improvement. We'll see if we can get some more follow through with that. Informational chart here, just going from the October 2022 low, the October 2023 low, and then the April 7th, 2025 low, and the percentage gains that we've seen since we hit those pretty important bottoms with the S&P. The distance from the 200-day simple moving average, we're above it, so it's green, and we're right now at 6.87% above that. We really pay attention to this and use it more for analysis. When it's just green or red like this, that's more informational. But if we get up into 12, 13, 14, 15% above the 200-day moving average, that's when we're starting to get far away from that moving average, and quite often we'll see a bit of a pullback there. We're not there now, and so this is mainly just informational at this point. And we use anchored moving averages as well, and we're above all of them. And the longer we stay up here, the more the anchored moving averages are starting to turn up. If we see some kind of a decline, one of these moving averages will quite often act as support, at least slow things down. We can slice through them. You can see, like when we were going down back in March and into April, we just went through a lot of these pretty quickly, but in a more not as intense environment, sometimes this will act as support. And I haven't been really showing a lot of the advanced decline line studies. There's one chart that I show that looks at all the different indexes, but I haven't been breaking it out that much lately because we're not seeing anything all that drastic there. We're setting new all-time highs, and that's coinciding with the price, with the S&P and so forth, like the NASDAQ and NASDAQ 100 that are setting all-time highs. So we're still looking really positive here, but we're not seeing any real big conviction. And again, we're below average with volume, which is quite common in the summer months unless something big really happens. But we're holding up fairly well here with the cumulative advanced decline line for the S&P based on price as well as volume, and just coming off of recent all-time highs. Then we look at the S&P 500 and compare it to the NYSE advanced decline line, and they're matching up more with each other. The advanced decline line itself is in an uptrend, which is positive. And so this is looking more at just the S&P 500 and comparing it to a broader market measure like the NYSE to see how they're lining up. And a cumulative advanced decline line for the NYSE came down in Friday's session, but we're just coming off of setting all-time highs here and down a little bit, but recent all-time highs with the regular NYSE advanced decline line and this other NYSE advanced decline line, which is calculated in a slightly different way. Common stock on the NYSE just coming off of all-time highs based on price as well as volume. And then I do an advanced decline ratio study, and I show that chart in every daily video. What you see on that chart is just price, and we were getting up to this green line, and now we're pulling back, so we were starting to get extreme. What this chart shows that the other chart doesn't is volume, and that had also gone above this green line, was getting extreme, and we've been seeing this coming back down. Large cap growth ETF, this kind of comes and goes out of the daily video, just recently setting an all-time high. We're above all the moving averages, and the moving averages are going up, and that's positive. And then the momentum stocks. Now, when we're going up with the S&P, sometimes we see this ratio actually going down on a comparison with the S&P itself. When this is going down, that means the SPY is outperforming the momentum stocks. But when we were really going down earlier in the year, this ratio was going up. As the S&P was going down, the momentum stocks were holding up better. And so we're dropping off here, and this is just confirming that we're seeing more strength in the broader S&P itself. U.S. versus international stocks, for most of 2025, this ratio was going down as U.S. stocks were underperforming international stocks. And then we started going sideways. Now we're seeing a little bit of strength here, but the U.S. has not come back and actually assumed a leadership role compared to the rest of the globe. Then technical alerts, not an awful lot this week, even though we had a 5-day trading week. There didn't see a lot of new things really triggered. Getting a mix, some positive, some negative. We have Canada that's doing quite well right now, setting all-time highs. But you start from the bottom and then you go to that's Monday, and then Friday is at the very top. And we're seeing a lot of blue or green here. But then we're seeing some other things like communication had a BPI cross below 70, tech sector a BPI cross below 80. A little bit of weakness right now. Staples had a bearish MACD crossover. I usually don't point these out individually in this video. I go through them each day in the daily video because usually the list is a lot longer than what we're seeing right here. And then we look at 6 indexes and we rank them on a score of 0 to 100. The better the score, the better that index is looking, just based on unemotional technical analysis criteria. Coming in first place, which has been in first place quite a bit, are the QQQs, which is the ETF for the NASDAQ 100. It's giving us a score of 78. Now, that's a good score, but when we're in the high 80s, low 90s, that's when we're seeing an awful lot of strength. And we've kind of leveled off here at this level for the last month or so, just below 80. But still, that's an improvement based on what we were seeing earlier in the year as we were going down. In second place is the NASDAQ composite itself, coming in at 77.3. Then we have the S&P, which mostly NASDAQ stocks are growth oriented, where the S&P is growth and value. It's coming in third place at 70. Then we have the Dow at 53.5. That's a pretty big jump from the S&P down to the Dow, but it's still above 50, so it's having more of a positive slant. Then the mid caps, which were actually in last place a week ago, now they're next to last place. And they were improving and coming up into the 40 range here. And right now they're at 42.1. A little bit of a drop off in Friday's session as they gave back a lot of the gains that we were seeing throughout the week. And I hit the wrong button here. And then in last place is the ETF for the small caps. We were seeing some improvement, and they were having a pretty good week. But in Friday's session, they were down, and now they're coming in last place at 41.6. Mastering the stock market is challenging and can take decades to achieve. Most beginner traders and investors feel overwhelmed and often fail. Stay ahead with the SPX investing program. Members gain access to the full program. Other options include immediate access to videos as they become available. Alternatively, the daily and weekly newsletters may be helpful. Click on the link below to find out what's best for you. And we look at a short-term rainbow, which goes from 10 periods up to 50 periods. We're still well above the rainbow right now, and all of the lines are going up. This confirms that the short-term trend is positive. We look at the 20-period moving average. This is my definition of the short-term trend. We're above both of the lines, and the lines are going up. And we're even seeing the blue line above the red line, the exponential. That moves faster than the simple moving average, which is the red line. That just means there's a little bit more conviction behind this upward move. Then there's a 20-period simple moving average of the open, high, low, close. That creates its own mini rainbow. We're well above the rainbow, and all the lines are going up. I really pay attention to this chart if we start to retrace, because one of these lines may act as support if we start to decline, and we're far away from it right now. Then an intermediate term rainbow from 50 periods up to 100 periods, also above all of the lines, and the lines are starting to go back up. The intermediate term trend is still strong and looking quite positive at this time. Then we look at a 50-period moving average. This is what I use as a benchmark for the intermediate term trend. We see the blue line, which is the exponential version, above the red line. Prices above both. Everything is going up. That's a positive intermediate term trend. Then a little bit intermediate to somewhat long term is the 100-period moving average. Also seeing the red line, which that's the exponential, is above the green line, which is the simple, and price is above them, and everything is pretty much going up. We're starting to go back up here with the simple moving average. So there's an improvement, and we're well above both of these lines, and so that is also looking positive. And then I showed this in the daily video, but I wanted to go through it a little bit here. I actually expanded this a little bit. What we've seen over the last couple of years, because 2023, 2024 were very good years, but during those years, July started off really good, and then we had a pretty significant decline that took us all the way down into October, and then we bounced up off of that. And then in 2024, we were going up in July, and this didn't last as long, but we saw almost a 10% correction before we were able to bounce up off of that. Are we going to see something similar? Now, we had the big downward move in March and in April, and we've recouped that, and now we're back to setting all-time highs. But the first half of July tends to be strong seasonally. The second half, it underperforms. It's still positive, but this is around the time where what we were seeing in 2023 and 2024, we're wondering if something like that is going to happen again. There seems to be some evidence of a setup like that because August and September can quite often be weak. September is the worst month of all. Now, well, we don't know if it's going to play out like that or not, but we want to know about this ahead of time just to be aware of this so that we're not caught off guard where you got people freaking out. And the news lately, it's been, no matter what comes out, it's been taken as positive. That started to shift on Friday when some trade news and tariff news is coming out, and these deadlines from July 9th are now being passed. They've been pushed out to August 1st. There's trades deals going on. Is that going to switch over to being more negative? Where over the last month or two, it seems like any news is treated as positive. Is the overall attitude going to switch and look more pessimistic now? We don't know if it's going to play that way or not, but that's the way the pendulum swings quite often. We go, everything is looking positive to everything is looking negative, and then we just kind of go back and forth between the two. So we just want to be aware of this, that we've been looking pretty good, especially with this bounce coming out of the lows and setting ourselves up where 2025 from a seasonal standpoint, because if you go all the way back to January, we had an upward January, and when January is strong, that tends to do well for the entire year. There's no guarantees, but we're just looking at what has historically happened before. And so we just want to be aware that the last couple of years, even though we finished the year strong, about halfway through July or so, that's when things started to really pull back before they were able to resume going up. Then we look at the Connors RSI, which is another momentum oscillator. I only pay attention to this if we go above or below these black lines, and we're not there now. The S&P 100 is outperforming on a ratio basis with the S&P 500, and that's more positive. That's when the bigger stocks are outperforming the rest of the index. That's showing more leadership. And then the mass index. We're still working off of a signal on the weekly chart, but we're not getting a signal here on the daily chart. We're far away from the red dash line and the blue line. Didn't have enough movement either up or down with the point and figure chart to generate any new X's or O's. The last signal that was generated was an ascending triple top breakout that was generated on June 6th. And we're still working off of that as we were finally able to break out into new highs. Then CMB composite, which was looking extreme there right at the end of June into the early part of July, it's dropped back down below this black line. So I stopped using that in the daily videos. And we're below the moving average and going down as we've been slowing down here a bit with standard deviation, which doesn't measure direction. It measures speed. How fast are we going up or down? And I really only pay attention to this when we go above the moving average. Well, since we're below it, I've dropped this chart from the daily videos. And we were extreme with the percent B indicator. This is when we close, in this case, outside of the upper Bollinger Band. Since that time, we've been going sideways, but the Bollinger Band continues to go up, and that's working off some of this extreme reading that we were getting. A long-term rainbow starting at 50 periods, going up to 250 periods with moving averages, well above the rainbow itself, and the lines are starting to turn back up. This is suggesting that the long-term trend is improving and remaining positive. And then I mentioned this in the daily videos, a special K oscillator, very long-term. And I don't show this because we only get maybe 1 or 2 signals a year with this chart, and we are still negative. We're below this red line, but we are improving. Now, there's a weekly version of this that I also use, and we're still above the red line there. So longer term, we're still positive. On the daily side here, we continue to be negative. We do a weekly chart on top of the S&P 500 and then a weekly chart of the German DAX, the biggest stock market in the EU, and then look at the correlation between them longer term since it's a weekly chart. And after they had been diverging from each other quite a bit, we're seeing them coming back more into line right now as this correlation has been getting a little stronger. Then support and resistance, I'm not showing this lately because we really only pay attention to this chart when we're dealing with either the red or the green cloud. We're well above that, but there are some trending tools in this particular study. The green line, that's short term, and that's going up, even though it declined a bit on Friday since we had a down day. But overall, this is going up, so that's positive. And then more intermediate term is the blue line, and that's going up. And it's above the long-term line, which is the red. So it's positive because it's above the red line. And all of these lines, for the most part, are going up, even though we leveled off a little bit here with the red line, and we're above the cloud. So this chart is still looking quite positive. Broad market measures. Now, I look at the VIX, and I do a lot of studies with that. There's also a volatility measure for the NASDAQ 100 called the VIXN. I don't look at this all that much. I mean, I look at it every day, but I don't show it pretty much ever in the videos that I do on the daily side. But we have been dropping overall as the volatility of the S&P 500 has been dropping and below 20. We've also been seeing the volatility of the NASDAQ 100 dropping as well. Then we do some growth to value ratios here. We have the S&P on top, and then we do a growth, QQQs to value, diamonds, though. That's the ETF for the Dow. We look at that ratio, and then we see that the correlation right now is neutral. They were actually going in opposite directions there for a while. Now they're starting to strengthen with the correlation, but they're in that neutral area currently. We'll keep an eye on the transports because they've actually been showing some improvement. That's the red line here. They've actually, in a short-term way, have been outperforming the Dow. We're seeing the ratio going down. That means that the Dow is underperforming the transports. But we've been just range bound here. We come up, we set a high, we fall back. We just kind of bounce all over the place. It would help the market if the transports could show some more strength and actually continue to go up and possibly set a new all-time high, but they're not doing that yet. Then another sector between the regional banks, those are the smaller banks, and the financial sector. We're a little concerned about the financial sector. It's starting to underperform the S&P again and actually dropping below its 200-day moving average with that particular ratio. And I've been showing that chart every day for the last few weeks in the daily video. Well, this is a ratio between the smaller banks and the financial sector itself. And this is actually a bit encouraging. Even though we're still in a downtrend with the blue line below the red line, we're seeing this ratio going up. And that just suggests that the smaller banks, the regional banks, are starting to outperform. But we've been range bound here now for the last couple of years, but it would be nice if this could continue to go up and show some more improvement. Here's the bank ETF, not quite back to a golden cross yet, but still above both of the moving averages. We really saw some strength there. Now, we're going to get earnings reports from the big banks later in the upcoming week. And if they're positive, that could really help this ETF. If they're negative, that could put some pressure on this ETF. So we broke out, but lately we've been going sideways. But since we're above both of the moving averages, that's helped to possibly generate a golden cross. And we look at a ratio between energy, which it had a pretty good week, and the 10-year bond. And then we do a ratio with that. And for the most part, we've been going sideways. So we hit the upper end of this range, and then we drop down to the lower end of this range, so that we're not seeing an awful lot of conviction right now. Not like what we were seeing back in 2021 and into 2022, where this ratio was going up as energy was really outperforming. Another ratio between gold and the S&P itself, still below this downward sloping trend line here. It's not that gold is underperforming, it's just been going sideways as the S&P has been going up, and that's pretty much causing this ratio to continue to go down. Emerging markets, we're underperforming developed markets. And again, developed markets are like the US and the EU. And then you have all the other emerging markets as well. And they're starting to level out here. Starting in about May, we've gone range bound here. So we're not necessarily underperforming, we're stabilizing, but we're not really seeing this going up because emerging markets are not outperforming developed markets. And then this is kind of a weird one here. We take the 10-year yield in the US and the 10-year yield in Germany, and we subtract that and we come up with a figure here. And then we compare this to the US dollar index. And most of the time, the correlation between the top chart and the middle chart is pretty strong. Now they're really kind of starting to deviate from each other here. So there could be a shift that's coming here pretty soon. But we'll just keep an eye on this chart, and then we look to other indexes and other charts to say, okay, are we seeing a characteristic change in the overall market, especially in the relationship between the US and EU, or specifically German stocks. Here's the German DAX. It did retrace down to its 50-day moving average after setting an all-time high, and now it's starting to go back up. It was down on Friday, but it's just recently come back and set an all-time high. Then we look at another ratio here, US stocks to German stocks. When this is going up like it had been here, that means US stocks are outperforming. But for most of 2025, German stocks are outperforming, which was causing this ratio to go down. The QQQs, which is the ETF for the NASDAQ 100, still looking pretty solid here. We're above all of the moving averages. There's a 20, 50, and 200 period moving average here, and prices above, and everything is still going up. And so we're just setting recent all-time highs, not only with the NASDAQ 100, but with the QQQ itself. Rate of change charts, I just use these for information. Just Friday's close, and you go back 250 periods, and we're looking good from a longer term perspective here. This is that same thing, but going back to 1980, coming up above the zero line and continuing to hold up longer term. Bonds, we do a number of different studies here to say, okay, people have their opinion about inflation, and everybody's doing videos, and they're real dogmatic about, they think inflation's going to go up, they think inflation's not going to be a problem. I tend to ignore all that stuff. I mean, I listen to it because sometimes they have some insights that are kind of interesting. I may not agree with it, I may not conclude the same thing, but I pay attention to the market. What's the market telling us? Because that's really what matters. And so we look at a number of different ratios to see, okay, are we getting any insight here about what the market is thinking as far as inflation? The first one here is looking at cash versus the 3 to 7 year bond. When this ratio is going up, yeah, the market's worried about inflation and interest rates going up. When this is going down, the market's not worried about inflation or interest rates. And we've been just chopping along sideways. We're actually in a downtrend with this overall ratio. We came back up a little bit here, but we've been just kind of going along sideways recently. So on a short-term basis, this continues to show us that the market is not really concerned about inflation or interest rates. And we look at, change the players up here, and we look at out a little bit further. We look at tips, which do adjust for inflation and interest rates. That's what folks get into when they're worried about inflation and interest rates going up. Well, they're going down. Now, it did come up a little bit here, but we really haven't broken out. We're not seeing a lot of conviction overall. So this is also suggesting the market's not really worried about inflation and interest rates when we look at tips to 3 to 7 year bonds. We also look at tips to 7 to 10 year bonds. And it has been coming back up, but it hasn't really broken out here a little bit lately, showing that on a number of different time frames, the market is not really concerned about inflation. Then we look at the S&P on top, which is in red, and then the blue line, which is the long-term bond. And we look at the longer-term correlation here based on 50 periods, and they're starting to get stronger. They're tending to move more in the same basic direction with each other. And then we look at the short-term correlation, where they're tending to go in opposite directions of each other on a short-term basis. So if the long-term bond is going up, typically stocks are going down, and vice versa. We do that same thing here with the QQQs. We see that here in black, which is just coming off of setting recent all-time highs. And then the TLT, that's the long-term bond ETF. But the correlation right now is still continuing to be neutral overall. Not getting really any insight there. We want to keep an eye on the 2-year Treasury yield, which has been declining, creating a series of lower highs here and lower lows. That's been more market friendly overall. But we're not really getting a lot of insight from this chart other than in the bigger picture, we have seen the 2-year yield coming down. And then we look at Euro stocks, Eurozone stocks, and compare them with American bonds. The ratio is still pretty high. This just means that the Eurozone ETF is outperforming 3 to 7-year bonds. With each video and course, members learn to implement the consensus approach, a unique analytical method. Unlike relying on a few indicators that eventually fail, this approach overcomes analysis paralysis by using the weight of the evidence to draw conclusions. Developed over decades across all market conditions, explore the SPX investing program and start with a 30-day free trial. Then we look at the percent of stocks in the S&P above their 200-day simple moving average. I use this like an oscillator, but we're not getting an extreme positive or negative reading. The takeaway from this is that we're above this green line. We're above 50, and that's when we're looking more positive longer term. Then instead of looking at a 200-day moving average, this chart looks at a 50-period moving average. We're also above 50 and not looking extreme with the S&P. We also look at the mid caps above 50. They are showing some improvement here, but not giving us an extreme reading. And then we look at the small caps, which also were improving, but now are starting to fall back a little bit with those stocks above their 50-period exponential moving average there. And then a staples or S&P to staples ratio. We were concerned as we were really going down in March and April. We saw a real deterioration of this ratio. Since that time, we've been coming up as the S&P's been coming back up, and we're seeing a real improvement with this overall ratio. And that's more positive for the market. Thank you. I hope you're having a wonderful weekend, and I will talk to you in the next video.